Good afternoon, ladies and gentlemen. I'd like to welcome you all to the Monetary Policy Statement reading for the month of June 2024. My name is Andrew Wana, and I'm the Acting Director, Communications Department here at Bank of Uganda. And to start us off, I'd like to introduce the members of management of Bank of Uganda that are here with us. And I'll start with the Deputy Governor, Mr. Michael Ating Ego. So you're welcome.
Thank you.
Accompanying him and on his right, which is to your left, is Dr. Adam Mugume, the Executive Director, Economic Research. Dr. you're welcome. Representing the Executive Director, Supervision, we have Mr. Hannington Waswa. So you're welcome. And lastly, we have Financial Stability here at Bank of Uganda, Mr. Robert Babazize. Without further ado, just mention how the program is going. We shall have the monetary policy statement reading presented by the Deputy Governor, and thereafter we shall have the question and answer session. At this point, it's my singular honor and privilege to welcome the Deputy Governor, Mr. Michael Ating Ego, to present the monetary policy statement for the month of June 2024. So you're welcome.
Thank you very much, Andrew, and a very good afternoon to all our viewers and listeners. Welcome to the reading of the monetary policy statement for the month of June 2024. On 4th June 2024, the Bank of Uganda Monetary Policy Committee, MPC, maintained the central bank rate, CBR, at 10.25%. Domestic inflation has risen moderately, lower than we had previously projected, largely due to the exchange rate stabilizing with a bias towards appreciation since March 2024. The relative stability of the Ugandan shilling against the US dollar has benefited from the recent CBR increases and inflows from robust coffee exports owing to favorable international coffee prices. Uganda's inflation remains among the region's lowest, with an average of 3.2% in the 12 months to May 2024. Nonetheless, annual headline inflation rose to 3.6% in May 2024 from 3.2% in April 2024, while COA increased to 3.7% from 3.5%. The inflation uptick is primarily driven by rising healthcare, education, and transportation service costs, coupled with higher prices for solid and liquid fuels. Services inflation has climbed to 6.2% from 5.4%. Similarly, electricity, fuel, and utilities inflation has risen to 9.5% from 7.4%, reflecting recent increases in international energy prices and the lagged effects of the shilling's past depreciation. However, tight monetary conditions, declining global inflation, and a favorable domestic food supply have partially offset inflationary pressures. Looking ahead, inflation in FY 2024/25 is projected to remain moderate, broadly reflecting stable demand conditions and contained cost pressures. The inflation forecast has been slightly revised downwards relative to the April 2024 round, largely due to a less depreciated shilling exchange rate. Inflation is expected to rise and average between 5% and 5.4% in the short term, that is 12 months ahead, before stabilizing around the medium-term target of 5% in the second half of 2025. Uncertainties persist around the inflation outlook, including the potential impacts of an escalation in the ongoing geopolitical tensions in the Middle East, possible energy price hikes, unfavorable weather patterns affecting food supply, and production capacity pressures. Materialization of these risks could imply stronger inflationary pressures. Additionally, persistent global inflation and higher interest rates could cause heightened volatility in capital flows and the exchange rate, resulting in higher domestic inflation than currently assumed. Conversely, inflation may undershoot projections if monetary policy reduces demand more than anticipated, or global demand weakens further, resulting in lower imported inflation. Although the Ugandan economy remains resilient, recent economic indicators have been mixed but consistent with growth that's projected at 6% in financial year 2023/24. Indeed, the Composite Index of Economic Activity, CIEA, suggests a slowdown, with growth at 0.9% quarter-on-quarter and 5.3% year-on-year in the quarter to April 2024. Nevertheless, economic growth for financial year 2024/25 is projected between 6% and 6.5%, rising above 7% in the subsequent years. However, risks to the growth outlook remain. Uncertainty about the global economic situation and a stronger shilling depreciation could weigh on domestic demand. Private sector credit growth could weaken further due to tighter domestic financing conditions, resulting in lower demand. External factors such as a weaker global economy and escalating geopolitical conflicts could further impede growth through supply chain disruptions, higher freight costs, and reduced export demand. Furthermore, like several other countries, Uganda faces decreased capital flows, headwinds to export growth, and heavy external financing, partly due to rising global interest rates. This, combined with the debt support, has resulted in declining international forex reserves. Coupled with concerns over debt affordability and constrained financing options, this has led to a downgrade of the country's sovereign credit rating, though with a stable outlook, reaffirming that these challenges are only short-term. Going forward, rebuilding international reserves will require increased coordination of monetary and fiscal policies. On a positive note, more favorable weather conditions leading to good food crop harvests and private sector investment in the extractive industry and government intervention programs could boost economic activity. MPC assessed that while near-term balance of risks around inflation remains skewed to the upside, the current monetary conditions are adequate to contain inflation around the medium-term target of 5%. As a result, the MPC maintained the CBR at 10.25%. The bands on the CBR remain at +/-2 percentage points, and the margins on the CBR for the rediscount and the bank rates at 3 and 4 percentage points respectively. Consequently, the rediscount and bank rates will remain at 13.25% and 14.25% respectively. The decision supports the objective of bringing down inflation to its medium-term target while supporting economic growth, which is consistent with socio-economic transformation. The MPC will ensure that the monetary policy stance remains conducive to sustainable economic growth amidst price stability. And there ends the reading of the June 2024 Monetary Policy Statement. Thank you for your very kind attention.
So much, DG. The statement will be shared on the Bank of Uganda website and will also be published in the newspapers in the subsequent days. It will also be shared with the members of the media that are here. And with that, would now like to go into the question and answer session. Please kindly mention your name and the media house that you work for, and then you can go ahead with your question. We'll start off with Samuel Setumba from NTV, and he asks, what do you assess to be the impact of government fiscal consolidation policy at the end of the financial year vis-a-vis growth in domestic areas? That's from Mr. Samuel Setumba. We can start with that question for now, as it's the only question that we have. Thank you, DG.
Okay, I think what fiscal consolidation entails is efforts to raise or to increase tax revenues while rationalizing government expenditures to try to bring down the government budget deficits. And in rationalizing government expenditures, you only choose those expenditures that are productive, that address the social needs, while getting rid of non-productive expenditures. Now, my understanding of the payment of domestic areas is that the areas government pays are areas that have been verified. And those areas that are verified is what is considered in the budget for any budget. So, fiscal consolidation vis-a-vis areas payment, while aware of the fact that these areas are owed to the private sector, are also key for supporting economic activity. So it means that the faster government does verify these areas and puts them in the budget and considers them as a priority, is consistent with the story of fiscal consolidation.
Thank you so much, DG. We have two more questions. One is from Mr. Fred Ojambo from Bloomberg, and he asks, what is the outlook for interest rates given an expected increase in domestic borrowing by government? And Samuel asks another question, and he asks, you are forced to keep the monetary policy tight. Isn't the private sector headed for tougher times? Those are the two questions that we have for now.
Thank you. If I get the questions correctly, the impact of domestic financing on interest rates, and then the second question is to deal with tight monetary policy, and on what? On private sector credit, right? On the first one, certainly, you've all heard of the crowding out. When government increases its borrowing from the domestic financial system, it's said to be crowding out the private sector because the amount of lendable resources from the domestic financial system is assumed to be fixed in a short run. So if government increases, it is proportional borrowing from that from the system, from the domestic financial system. It means that the private sector is going to get less. So in terms of quantity, and also maybe in terms of the price. So there is that option of the private sector either paying a higher amount or just being rationed out in terms of the amount that is being allocated to it. And because government is also considered like a risk-free borrower, most of the lenders from the financial system would prefer to give to government. So certainly it's correct to say that as government increases borrowing from the domestic financial system, it impacts on the private sector through crowding out effect, which could be through quantities and through pricing. The impact of the policy rates on private sector activity. Look, when we adjust the policy rates, we have an intention of keeping the inflation at our medium-term target. So we take a long-term view about inflation. Inflation may be 12 months down the road. If the inflation 12 months down the road does go beyond our medium-term target, that's when we then change the policy rate. And changing the policy rate is certainly meant to lower aggregate demand. And one way that you can lower aggregate demand is through higher pricing of credit from the banking sector. So it's true that higher interest rates, particularly policy rates, could lead to reduced demand from the banking sector by the private sector through higher interest rates. But if you were to ask me in the case of Uganda, it's true that because we have been raising the policy rates, we have also seen that private sector credit growth has been slow, it's been anemic in the single digits compared to the double digits that we had about 5 or so years ago. But we need to be careful when we look at those numbers because there are many other avenues through which the private sector is now getting credit. For example, government is borrowing money or is raising money through taxes or borrowing money from the banking system to finance initiatives like EMIOGA, the Parish Development Model, and what have you. So ordinarily, this credit or this part of the sector would have come to the banking system to borrow, but now they're getting credit from the government. So does it explain the slow growth in the private sector credit that we're seeing in the banking sector? I think that's an empirical question that we're looking at, but there's a likelihood that it is affecting the demand for credit, and hence maybe the slow growth rate that we're seeing in the formal banking sector credit extension. Because you have things like via the micro support center, via UDB, via EMIOGA, via PDM, all that money is coming from government. So is it crowding out the private sector? It is an empirical question.
Thank you so much, DG. And now we shall go for the last round of questions. Please go ahead.
Okay, thank you. My name is Victor Taibwa. I work with NBS TV. DG, my question is in line with the first one. Is government still pursuing the fiscal consolidation policy, or it is now on budget expansion?
That question, we need to go for the long haul. Where are we coming from in terms of the fiscal deficit? Let's go like 5 or 6 years ago. And where are we today? Is the fiscal deficit smaller than where we were 5, 7 years ago? I think it is, right? But you can also argue that maybe where we wanted to be, all right? We have not been there. And you need to ask yourself why. I think there have been lots of pressures on government. For example, there are things like floods. You know, the bridge, Katonga Bridge breaks down, this bridge is washed down. These are things that you are not planned for. So do you leave the bridge unattended to because you want to achieve a certain fiscal deficit? But I think overall, there's fiscal consolidation taking place if you take it from the long haul. But in the interim, inter years, it may keep varying. You might have wanted a smaller one, but slightly higher, because of some emergencies that come. But maybe Adam, you can weigh in on this one.
Did you say, I think in 21, 22, for example, fiscal deficit as the share of GDP was around 7.7. It dropped to 5.1, I think, that is 22, 23. Yeah, and then we're expecting to be around 4.3 this year. Also, in the next financial year, it edges up a bit according to the budget, and then starts coming down. So, overall, when you analyze the trend, you see that yes, remember the target is 3% under ESC over the rotation. You discover that by 2026, 27, actually will be below the 3% of the compared to ESC companies with data. So once you look at in that way, the trend, given the fact that you have one-offs, for example, like next year, I think you have things like when you increase the railway line expansion, then you have a bit of an increase. But overall, I think you have to see that it is converging toward the 3 under ESC.
Lastly, we have a question from Mr. David Kavuma, and he asks that with the current level of government debt, how does Bank of Uganda perceive its impact on monetary policy decisions and the overall stability of the economy, particularly in relation to the interest rates and the currency strength? I'll repeat. With the current level of government debt, how does Bank of Uganda perceive its impact on monetary policy decisions and the overall stability of the economy, particularly in relation to the interest rates and the currency strength?
Okay. I think the level of debt, when measured as a percent of GDP, may not be that worrying. I think what should worry us most is the ratio of things like debt service to tax revenue, debt service to exports. There are countries whose debt to GDP is about 150, 200%. And they are able to sustain it because the liquidity ratios, that is, the debt service to tax revenues, debt service to exports, are very, very low. Now, in the case of Uganda, the debt service to tax revenues is anywhere north of 30%. So what that means is that for every 1 shilling you collect in tax revenues, you are going to spend 30 cents servicing debt. So what happens is you are crowding out other expenditures, such as social expenditures meant for health, education, for infrastructure, for development expenditures. So as this increases, for example, it's moving towards the mid-30s now. It means that you're having fewer and fewer resources for some of these expenditures. So that's how I see the impact of this debt on these other things. Now, if you take, for example, external debt, you are borrowing in hard currencies like the US dollar, euros, SDRs, what have you. Now, if the investment, if what this money is borrowed for, is not generating a supply-side response for exports, it means that your capacity to service this debt, which is going to be paid out in foreign currencies, is going to be constrained. And that's why, as a central bank, of course, we are concerned that we are not generating sufficiently enough dollar resources to service our debt. And as a result, we are falling back into our international reserves to be able to service this debt. So although government is providing the shilling equivalent for servicing external debt, it is the level of foreign exchange reserves that is being affected, and it partly explains why the foreign exchange reserves have come down. So we need to ensure that whatever external borrowing we are undertaking has the capacity to generate sufficient export revenue, generate hard currencies to help us in servicing external debt. Otherwise, it will keep on affecting the level of reserves by draining it down. Now, how does it affect monetary policy? If the level of foreign exchange reserves dwindles very fast, it has implications on the exchange rate. And once the exchange rate depreciates, it has an impact on the price level. So it means that domestic prices will go up as a result of a depreciating currency. Now, if we are going to maintain our inflation objective of 5% in the medium term, we have to tighten monetary policy to achieve that. So that's how I can quickly respond to that question in terms of monetary policy. But maybe, Adam, you have been at this game for long.
Again, I think it's a question of differentiating between now and tomorrow. Now meaning this fiscal year and probably next, and then with the outlook. We are talking about the data accumulated over the period, going into roads, going into the oil infrastructure, and also going into the energy, the power dams. So the question therefore is, are these investments that the government incurred today, which we are serving today, and we are talking about high data dynamics, are they able and will they in the future generate more growth and probably the dollars? Think about the oil. The government borrowed money for the Hoima roads, oil roads, and then the airport. And also we know that investment in the pipeline. So that one, I think probably in 26, 27, and the years ahead, you see that that is going to generate the inflows in terms of the dollars. The roads infrastructure, the similar story, and the airport, and obviously the energy. So the question therefore will be, yes, we are going to have the pain today, including the private sector, and probably some of the challenges we're talking about, even possible tightening monetary policy if inflation edges up. But again, this is in the short run, on the assumption that come 2 years down the road, 3 years down the road, when some of these inflows start, now public investments now will start paying off. And then that's when we are able to service the debt going forward at really minimal cost. So the challenge and the debate therefore is between short term, which is 12 months or short in the near term, vis-a-vis the medium term. And looks as if the medium term is well sorted out because some of these investments will pay back. So the pain to the private sector and some of the challenges we are talking about is probably within 1 or 2 years down the road. And indeed, there are substantial challenges in terms of, yes, as DG said, we are talking about 30% of the tax revenue is going to debt service. The median for low-income countries, most of them Africa, is around 10%. So Uganda at about 30 means that we are really in the red on that in that angle. But again, as I say, this should be judged. That's what I can add on. Thank you.
And maybe just to say something again. Look, you should also ask yourself, how come that we are having these pressures now? The international or the global financial architecture has changed. In the past, we used to get concessional financing. This is financing that's of a long-term nature, right, with a long grace period and fairly low interest rates. But that kind of financing has since changed. Now the only available financing that's really available is commercial financing. And the terms for this commercial financing are quite hard. So now you have to choose, do I get the oil out of the Albertine region or don't I get it? If the only financing that's available is commercial financing, and you look at all the multiplier benefits of getting that oil off the ground, I think it's very important that you make that decision. Go for commercial financing, as long as the rate of return from that financing is high enough to pay off that rate. So now in the case of Uganda, we need to get the oil off the ground. We need to invest in the roads. We need to invest in the infrastructure necessary to get the oil to the markets where they're supposed to, to get into. So we went for these loans that have a short grace period, right? And therefore, bringing now the burden to the near term, like Adam has mentioned. But there is light at the end of the tunnel. That if you look at the balance of payments, 2-3 years down the road, we are expecting an improvement, and that should be able to help us navigate through all these challenges that we're facing. Certainly the next 2 years is quite challenging, and that's why I mentioned earlier on that strong coordination between monetary and fiscal policy is much required in these 2 years because the outlook is stable. And we are not saying this as Ugandans. Even the international rating agencies agree that while the short term is challenging because of this debt servicing, the outlook is stable.
Thank you so much, Deputy Governor. If there are no other questions, I'd like to thank the Deputy Governor and management of Bank of Uganda for the responses given to the questions from the media fraternity. I'd also like to thank the members of the media here present physically. Thank you for coming. And I'd like also to recognize the staff, the internal stakeholders of Bank of Uganda who have joined us through Microsoft Teams, and also the media who have joined us through Microsoft, our YouTube channel. Once again, the media statement will be available on the website, and the Q&A session that we've just had, the transcripts will also be ready in the website. With that, ladies and gentlemen, I'd like to thank you, and I'd like to bring this meeting to a close. Thank you so much.